大家好啊，欢迎来到大佬透镜在 YouTube 的频道。我们用一张 PPT 讲透大佬的深度分析。我们今天来聊一聊日韩市场、中国市场，包括美联储的货币政策走向。还有就是在现在这个全球的 AI 算力、半导体、能源转型和国防军工这些产业资本开支都明显提升的大背景之下，我们应该怎么样去均衡的在成长和防御之间去做一些配置？
这个话题非常的重要，那我们就直接开始吧。
咱们先来说一下韩国市场啊，韩国市场最近也是经历了比较大的波动嘛。那到底是一些什么样的因素导致了这个波动？
就是说韩国的这个大盘其实之前是有过一轮比较大幅度的回调，然后最近在一个关键的点位暂时稳住了。那这里面主要的压力其实是来自于科技和芯片这一块，大家对于 AI 的这个产能的周期，包括数据中心的建设进度，还有就是韩国本土的这些大规模的产业投资政策的落地的节奏，大家是比较担心的。
看来这些产业政策的不确定性确实让投资者比较忐忑啊。
是的，那韩国政府其实也推出了非常大规模的产业政策，就是未来要投入2000万亿韩元来发展半导体集群、AI 数据中心和实体的 AI 赛道。所以其实整个产业链的资本开支是进入了一个上行的周期。
对，
但是因为各个细分领域的资金落地的节奏还不是特别清晰，所以这也加剧了市场的一个波动。那另外一个就是韩国的全国养老金机构也出来说了，他们的资金调仓会是比较有序的推进，对市场的冲击是可控的，这在一定程度上也缓解了大家对于养老金再平衡的一个担忧。
明白了。那韩国市场里面有哪些投资主线是大家可以去关注的？
有4条比较核心的投资主线。第一个就是能源安全，那这个其实是跟 AI 的需求是紧密相关的，因为中东的地缘冲突其实也在改变全球的能源格局，所以包括核能、电力设施这一块的资本开支也是持续的提升。那再加上 AI 算力对于耗电的需求其实是不断的在增长的，所以核电、电力设备、油气和可再生能源这几个方向其实都是比较有长期配置的价值的。同时也会带动像三星、ENI 这样的一些海外的工程企业。
这是能源安全。那其他3条主线是什么呢？
第二个是国防军工，就虽然大家短期会担心说冲突缓和了是不是订单会减少，但是其实现在各个国家都在从被动防御转向主动威慑。所以导弹、防空系统和陆战装备的需求是持续在提升的。那这个里面航空航天是大家比较看好的一个细分赛道。第三个是财富效应，就是消费复苏。韩国的入境旅游是非常火爆的，那政府也是预计今年的入境游客会超过2100万，所以百货、便利店、线下服务这些行业都是直接受益的。那这个财富效应也是在不断的向价值股和成长型的消费标的去扩散。那最后一个就是企业改革，尤其是在金融板块。那银行其实是有4大催化剂的，包括证券业务的收入提升、信用卡消费带动财富管理、市场对于多次加息的预期，还有就是今年下半年的资本市场法案和反垄断法案的落地。这些都会给金融板块带来比较大的改革的动力。
那在这种市场环境下，投资者应该怎么去做资产配置，才能够在抓住成长机会的同时又做好防御呢？
其实现在比较主流的策略就是用杠铃策略，就是大家会把自己的资金比较均衡的分配在2个方向，一个方向就是成长端，成长端主要就是集中在工业和科技 AI 产业链，另一个方向就是防御价值端，那这个就包括医疗、金融和高端消费。
好的，那说到这个 AI 产业链，最近美国那边数据中心的建设好像是有一些变化，这对整个产业链会有什么样的影响呢？
美国那边就是超大规模的数据中心，他们的建设节奏确实是在短期内变得更加谨慎了一些。但是其实他们的中长期的投资计划并没有被打断，也没有什么系统性的资金风险，只是会有一些阶段性的建设延期和产能瓶颈。
那也就是说 AI 产业链的中长期的逻辑还是没有被破坏的。
对，那尤其是 AI 算力和实体 AI 的快速发展，其实是在不断的推高对内存的需求，所以存储这个板块其实是中长期是向好的。那短期的话可能会因为市场情绪的波动会有一些疲软，但是其实反而是一个机会。
聊完韩国，咱们再来说说日本市场啊。最近大家也看到了，外资对于日本股市是持续的加码。那到底是什么原因让日本成为了国际资金的一个新的宠儿呢？
就是现在很多海外的投资者都在看好日本的股市，那他们的资金流向也很明显，就是在减仓美股，然后再加大对日本的配置。其实背后有一个很重要的原因，就是亚洲的资金现在觉得 AI 和台积电这些相关的股票已经太贵了，所以他们把资金分流到了日本的 AI 产业链，这就直接推高了日本股市的一个人气。
原来是这样啊。那日本的这个 AI 产业链，它的轮动有什么特点？或者说现在有没有一些特别值得关注的细分赛道？
日本的这个 AI 产业链的轮动其实是非常有规律的。那在最开始的时候是光学元器件这个板块会先启动，那接下来就会轮到内存和半导体检测设备，再接下来就会是功率半导体和数据中心设备。
听起来好像每个阶段都有一个领涨的板块。那下一阶段的焦点会是在哪个环节呢？
下一个核心的瓶颈环节可能会出现在 X 射线检测设备，因为现在 HBM 的多层堆叠芯片的结构越来越复杂，那它的这个层间的对齐还有键合缺陷的检测就变得非常的关键。 所以 X 光检测设备就会变得不可或缺。那相关的企业，比如说奥摩、哈马光子、莱尔、卡斯威尔、恒河电机，还有 MIT 电子，这些从事混合键合和半导体检测设备的企业，就会迎来一个估值修复的机会。了解了。
那最近日元的汇率波动也挺大的，这背后的主要的驱动因素是什么？
日元走弱最主要的原因还是美元太强了。就如果我们把美元的因素拿掉，其实日元在即时货币里面还算是比较稳健的。那日本的当局其实也说了，如果必要的话，他们会果断的出手干预，但是他们目前还没有把做空日元的头寸定义为投机，所以短期内大规模的进场干预的可能性也不是很高。
如果说日本真的出手干预汇率这对于日本的股市，尤其是那些高动量的成长股会有什么样的影响？
假如说后面日元继续大幅的走弱，然后触发了干预，那投机的空头可能会集中的平仓，这就会在短期内推高那些高动量的成长股。但是今年夏天那种单边的行情可能也很难复制，因为现在美日的利差还是在扩大的，美国的财政压力也很大，所以这都会削弱日元干预的一个长期的效果。就是可能反弹的时间会比市场想象的要短。
是的，最近日元的套息交易也很火这个里面会隐藏着什么样的风险？
现在日元的套息持仓的规模已经快要接近2024年那次大规模干预的时候了，所以如果一旦出现了这种资金集中平仓的情况，市场的波动肯定会放大。所以这个时候大家最好还是避开那些高波动高动量的个股，不然的话很容易被这种突然的反转给伤到。
明白。那日本的股市里面哪些行业是机构比较看好的，哪些行业是他们比较谨慎的？
现在机构比较倾向的是 B2B 的上游供应链，比如说化工、非金属材料、建筑、大型商社，还有科技硬件。因为这些行业一方面是受益于全球的 AI 和资本开支的周期，另一方面就是他们在整个产业链里面的议价能力更强。
那 B2C 的消费和银行股为什么就不那么受青睐呢？
B2C 的消费就是食品、医药、汽车、零售、物流这些，因为他们没有办法把上涨的成本转嫁给消费者，所以他们的盈利是受到高通胀的压制的。那银行股的话，就是虽然现在市场是预期终端利率可能会升到 2%， 而且银行股短期的盈利和股东回报看起来都不错，但是机构其实是担心日债收益率随时有可能下行，就是加息能不能持续其实是存疑的，所以机构也不敢去大举的加仓银行。
说的很有道理那我们下面要聊的主题是美联储的货币政策的解读。最近市场对于美联储的利率走势非常的关注那现在到底是一个什么样的核心的判断？
目前的主流观点是，美联储很有可能会在2026年整年都维持利率不变，就不会再加息了。其实市场之前是有点误判了美联储的点阵图，因为当时点阵图出来的时候，中东的原油协议还没有签署，所以那个时候美联储的官员其实是没有办法把油价回落的这个因素算进去的。
对，
所以他们其实是高估了未来的通胀的压力。
所以说油价的波动其实只是一个短期的扰动，
对，
并不是一个核心的影响因素。
没错，因为高油价对通胀的推动最多就是1个季度。你看欧元区的 CPI 已经在显示能源推动的通胀在回落了，那美国其实可能在今年的7、8月也会看到这个通胀数据往下走。
那从中长期来看，到底是什么东西在真正的驱动美国的通胀下行呢？
其实最大的一个动力就是关税的影响在逐步的消退，因为关税到今年已经满1年了，所以它之前对核心 PCE 通胀推高的65个基点，会在未来的6到9个月的时间里面慢慢的消失。这个其实是比油价、劳动力、AI 这些因素都要更持续的一个下行的压力。
那美联储的主席最近在沟通的方式上面有没有什么新的变化？
其实政策目标还是没有变，就是还是锚定2%的通胀目标。但是他现在的沟通风格有点像回到了格林斯潘的那个时代，就是他的政策信号变得更模糊了，所以数据的波动就很容易引起美债和权益市场的大幅波动。尤其是今年的7月和9月的 FOMC 会议会是大家观察新的信号的一个重要的窗口。
听起来市场要适应这种新的沟通方式还需要一些时间
对，而且接下来其实美联储的任务委员会的人事任命，还有他们对于资产负债表的调整，以及他们沟通的一些细则，都会成为影响市场定价的非常关键的因素，所以投资者是需要密切的去关注这些变化的。
聊完了美国，我们再把目光转向中国就是中国的宏观经济、中欧贸易和产业分析。最近中国的这个经济出现了比较明显的分化，那主要是体现在哪些方面？
目前就是 AI 和能源转型相关的出口制造是非常景气的，但是国内的消费和投资其实是持续偏弱的。那2季度的 GDP 的增速可能只有 4.4%， 就是低于全年的这个目标区间的。
那现在这种财政约束的情况下，政策的重心会放在哪些方面？
因为财政赤字已经快要接近 2% 了，所以下半年其实也不太可能会有大规模的全面的消费刺激。那政策的重心就会放在加快推进基建项目上面，比如说 AI 算力中心、智能电网。对，那在消费补贴这一块是没有什么新增的动作的。
明白了。那怎么看现在中国经济面临的一些中长期的困境呢？
最大的挑战还是在于供给过剩、内需不足。 所以通缩的压力一直都没有散去。那地方政府还是比较看重产出的规模，像社保和直接税的改革又推得比较慢，那居民的预防性储蓄的意愿就很强，所以消费就起不来，那整个经济的再平衡的进度就会被拖慢。
没错，那中欧之间的贸易摩擦现在也是大家很关心的一个问题，就是中国对欧盟的出口到底面临多大的风险？
欧盟是中国的第2大出口市场，占到中国总出口的15%。那大概有2/3的对欧出口的品类是有可能会被加征关税的。那这里面就包括了新能源车、机械设备、化工和基础材料等比较重要的行业。
那在这么大的一个风险敞口下面，中国有哪些应对的手段？企业有哪些应对的手段？
其实全面的脱钩的概率是不大的，因为欧盟的新能源的供应链是高度依赖中国的。那双方也已经建立了贸易投资的协商机制。那中国方面的反制的措施，目前来看也是比较温和的，比如说稀土的出口管控，提高市场准入门槛。
对，
那另外就是企业这边也在加快把供应链外迁，或者是说通过 RCEP 和俄罗斯等其他的市场来分散风险，还有就是积极的去推动海外建厂，来规避这些贸易壁垒。了解了。
那合肥的这种产业发展的模式有哪些地方是比较独特的？
合肥模式的一个亮点就在于，政府不光是给土地补贴，它还会主动的引入风投。然后进行产业生态的规划，来打通供应链的堵点，来扶持本地的龙头企业。
对，
那赚到的钱再投入到新的战略产业，就形成了一个以市场化的方式来推动先进制造，不断的实现突破。
那这个模式如果要在全国去推广，会遇到什么样的难题？
合肥的这个模式其实是离不开它自己的这个区位优势以及产业发展的时机的。如果全国都去照搬的话，反而会加剧产能过剩的问题。因为产业政策顶多就是优化资金的分配，但是解决不了国内的这个结构性的矛盾，比如说供给过剩，或者说内需不振。
那中国的股票市场，就是 A 股和 H 股，在今年下半年会有哪些值得关注的投资机会？
现在有越来越多的外资开始重新的去审视中国的股市，其实有3大底层的逻辑。第一个就是全球的资金在 AI 相关的资产上面已经过于拥挤了。那中国的股市跟全球的主要市场的相关性又比较低，所以它是一个非常好的分散风险的一个选择。
所以说，除了这种分散风险的需求之外，是不是估值的吸引力也开始显现出来了？
没错，因为 A 股和 H 股今年是明显跑输了日韩台的市场的，所以估值已经回落到了一个比较有吸引力的水平。那很多资金其实在博弈的就是一个均值回归。再加上大家对于后续的稳增长政策和产业刺激的政策是有预期的，所以这也会给周期板块带来一些轮动的机会。
那现在这个估值水平是不是已经到了可以大胆去抄底的这个时候了呢？
现在 MSCI 中国指数的市盈率大概是在10倍左右。虽然说已经低于历史的均值，但是还没有到历史的极端底部，比如说9倍或者说9倍以下。那历史上出现这种极端底部是在2022年的10月、2024年的中，还有2016年。对，只有到了那个时候才是无脑配置的一个时机。那现在跟其他的新兴市场比的话，也就是有15%左右的折价。但其实历史的折价中枢是在30%，所以单纯的去看估值的话，其实吸引力也不是特别的足，所以不建议大家去盲目抄底。
是的，那为什么 A 股和港股会出现这种分化？到底是什么原因导致的？
港股里面互联网平台的占比是非常高的，那这些企业因为受到消费低迷和价格战的影响，所以他们的业绩是持续承压的。但 A 股里面有很多是高端制造和 AI 硬科技的公司，那这些公司其实是更贴合全球的资本开支的一个大的方向的，所以 A 股反而在长期是更容易跑赢港股的。
所以说，如果我们想要去捕捉港股的一个拐点的话，我们应该重点去关注哪些信号呢？
有3个比较关键的信号。第一个就是2季度的财报。那如果说电商的价格战的监管是有一些放松的，那其实平台的盈利是有边际改善的机会的。那第2个就是3季度能不能够看到互联网企业去大规模的落地大模型 AI 生态，能不能够真的去实现商业化，这是非常重要的。那第3个就是7到9月这个期间会有比较大的 IPO 原始股的解禁。那如果说市场的流动性可以扛得住这个压力的话，其实7月末和8月底是有可能会出现一个比较显著的修复窗口的。但是机构也是建议说，还是要等到这些数据出来之后再去加大你的仓位。
好的，那面对这样的一个市场环境，机构在资产配置上面会有哪些具体的建议？
机构比较看好的是亚洲的硬科技和全球 AI 产业链的龙头。那在 A 股里面去选这些标的会比在港股里面去选更好，就是尽量的去避开港股的互联网。
那除了这种进攻性的配置之外，哪些是属于防御性的底仓的选择呢？
高股息、现金流稳定的一些资产，比如说煤炭、能源、保险、基础材料，这些是可以作为防御底仓的。然后他们也建议说，最好是不要去碰那些纯内需消费的赛道，因为国内的需求到底能够复苏到什么程度，还是有很大的不确定性的。
有道理。那最后我们来总结一下，就是说这一次的会议到底给我们勾勒了一个什么样的全球市场的投资全景？
这一次会议其实梳理出来了几条贯穿全球的投资主线，就是 AI、算力、半导体、能源转型和国防军工。这几个方向其实在日韩、中国、美国都是处于一个比较明确的资本开支的扩张周期。
是的，那不同的区域市场会有哪些结构性的差异是值得我们去注意的呢？
日韩市场的话，是在 AI 设备、检测、存储这几个产业链环节是收益比较明显的，所以他们可能在短期内会有一些超额收益。那中国的话，因为现在整体的估值还没有到底部，所以比较适合去布局高端制造，但是对于内需消费和港股的互联网这一块还是要谨慎一些。
那在这种宏观环境充满挑战的情况下，大家在做资产配置的时候有哪些比较通用的思路呢？
其实现在大家普遍都是用一种杠铃策略，就是既抓住 AI 高景气成长的这一头，同时又配置一些高股息的防御性的资产。那大家都在尽量的去避开那些估值已经很高了，或者说纯内需消费的这样的一些板块。那等到政策、财报或者说估值出现了一个比较明确的拐点之后，再去进行一个仓位的调整。
行，那今天我们聊了日韩，聊了中国，聊了美国，聊了这些主要的市场的投资机会，包括风险点，包括一些资产配置的策略。那大家可以根据自己的风险偏好去做一些参考。
好啦，那这一期播客就到这里啦。感谢大家的收听。
后面是完整版，请有空的朋友继续。这里是 YouTube 大佬透镜，我们致力于过滤垃圾信息，挖掘优质内容，请大家订阅、点赞、评论，这样算法下次就会第一时间把我们的更新直接推送到您的屏幕上，您就不用再费劲去打字去搜索了。
Good morning and good afternoon, everyone. It is July 2nd, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Active Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you're in the press, please log off and reach out separately. Please also note that this session in questions may be recorded. Today, we have Brigitte Sibol, Senior Global Economist, Jun Sok, South Korea Active Strategist and Head of Korea Financial Research, Laura Wang, Chief China Active Strategist, Sho Nakazawa, Japan Active Strategist, Jenny Zheng, China Economist. During this session, you can send us questions at any time from the Ask a Question text box. So today we have June with us to talk about the views on Kospi, and then recently we have a major correction and there's a lot of debate on AI capacity. So June, can you share your views on whether this is more like a brother or a breakdown? And then seems like banks are performing very well as well. Can you share your top picks if people want to broaden out? Over to you, June.
Yes, thank you, Crystal. So yeah, we came out with a report recently titled "Shaken but Not Broken." So we keep that view at this point. Now today it seems that we did break below 8,000, but we're kind of staying at that level. And I think generally there's been a bit of fatigue that's built up into the market, and particularly for the tech side on the chip makers. And it's largely because I think there's a lot of different news flow coming out in terms of, for example, the AI capex cycle and how that's going to play out, the data centers and the build out there, whether there could be some delays there. And of course, we had the recent news flow about South Korea, where the government announced that there's going to be a 2,000 trillion won investment into semiconductor clusters, AI data centers, and also the physical AI side. So there is a lot of investment going on, and we don't have the clear idea of how much that's going into each of the areas, but generally are going to see more investments being done. And I think generally just marketing in Asia, Australia, and the U.S. There's still a lot of questions surrounding where else could we be, except for the tech, because most I think investors are there right now and are looking to kind of broaden out and see where there are also stories kind of playing out in Korea. So when we kind of move away from the tech side, there's still a lot of interesting stories, I think, for Korea. And as we kind of broaden out, the four key stories that we're kind of talking about is number one, energy security, and this has linkage to powering AI. We're also talking about the defense side still, and it seems like we had a bit of a correction here, but the story is pretty much intact. And the third is related to the wealth effect, and the department stores kind of started the story, but potentially it could move into other areas because of the inbound travel also building up. And just fourth, just reform and kind of value stocks also, as we do think that there's going to be a bit more of a news flow in terms of the corporate reform. So let me just go through like the 3 points there. But before I do, just wanted to kind of mention one point. We are getting a lot of questions surrounding the pension fund rebalancing. And our view has been that this will be done in a controlled manner, and the market impact should be manageable. Yesterday, the CEO of National Pension came out and said that there are a lot of kind of numbers coming out about what the flows could be, but he said once again that it will be done in a controlled manner. So just moving on to the kind of the four kind of stories there. In terms of energy security, I think there is a linkage to AI, but also aside from that, the Middle East conflict has kind of changed the paradigm a bit, and we are getting once again, I think a bit more questions on the nuclear side. There is continued interest, I think, in the power generation stories like HE Hyundai Electric, which is in our focus list. So the energy security side, I think, will continue to get interest, and we do have a very positive view on the capex cycle in Asia too. And there's linkage to like overseas ENC, where we like Samsung ENA, which is pretty also much linked to that story too, but maybe more so on the hydrocarbon side and also renewables. But nonetheless, there's going to be, I think, a buildup of more potentially plants in the Middle Eastern side and reconstruction happening there. So another story that's kind of linked there. And on the defense, we would say that as the conflicts kind of simmer down, there seems to be a view that in terms of new orders, maybe there is a feeling that the orders don't really play out because of the simmering down of the conflict, but we actually do think it's more opposite, and we are seeing definitely, I think, a change of the tone from passive defense to more active deterrence, and hence, so we do think that missiles like Chunmoo would be more in demand, and so is also air defense, but also land system side should be where there will be a lot of interest too. So we still have Hana Aerospace as our kind of preferred pick here, and again in our focus list. And then we kind of move towards, I think, the wealth effect, and the department stores are still doing very well. Inbound travel last year was 18.7 million. This year, I think the government's expecting around 21 million or more. And this pickup could be stronger depending on kind of how the situation plays out in terms of where the ASEAN travelers and also other travelers, whether they will choose Korea as more of a destination. And some of the areas that have done well previously has been like convenience stores and also other kind of service areas. But for department stores, we still think that the story is intact there. And just to move on to the reform story and the financials, financials have done quite well. And for the banks, there's really four stories that's playing out. One is that we are seeing the securities business doing well, and each of the banks do have a pretty sizable side business there. And also, they're benefiting from, I think, the wealth effect because most of the usage is being done by credit card. And also, we're going to expect a BOK rate hike cycle where Kathleen O, our economist, expects 4 more hikes. And just to add on, we do think that the TSR will continue to go up. So we do think there'll be a more news flow on the corporate reform, such as the Capital Markets Act and also the Anti-Stock Suppression Act. So something to follow as we get to the second half. And just to kind of finish off, we'd like to say that I think maintaining a barbell strategy for Korea does kind of make sense. So we do have industrials and tech as our top, but we also do like healthcare, kind of financials, defense, and high-end consumption plays here. So I'll stop there and hand it back to Crystal.
Thank you so much, Jun. Before you log off, just want to check: do you see any risk on the tech side from the US hyperscaler becoming more prudent in the CapEx build-out outlook?
Yeah, again, I think a question that I did get a lot, I think, from investors here, but we still do think that hyperscalers will be investing, and I think that as they continue on, and financing, I don't think is really kind of issue here. And going forward, if as all the players really want to become the winner there, investments will continue. But of course, there could be bottlenecks out there, such as data centers being delayed and all that. But I think it's more important to kind of see whether token usage is going up, and it seems like it is. And also, if you are going to agentic AI and physical AI, the demand for memory should continue to grow. But as I mentioned at the start, there is a bit of fatigue because of the different stories or narratives that are playing out. But we continue to be positive on the memory story.
Got it. That's very clear. Thanks so much, June, for still dialing in at such a late time in US. And then now we are moving on to Japan strategy. Today we have Show with us. And then Japan seems to have a steady bull market, and then the foreigners remain very bullish there. Can you share your marketing feedback for the last several weeks? And then also, can you share your sector preferences within the space, and then also talk about the implications from a weaker yen as well?
Sure. Thank you, Crystal. So in the recent trip to Korea, the investors' view on Japan equities was very constructive. Many investors said that within the Asian equity portfolios, the exposure to AI-related names in Korea and Taiwan is already very full. So because of this, their interest in Japan equities is very high. And some investors also said they plan to reduce their US exposure and increase their allocation to Japan. We discussed a wide range of topics, and among them, the most interesting discussions were about what the next technology bottleneck could be for AI investment, and how to think about hedging a reversal in the AI rally. And on AI and data center investment, Korean investors are generally bullish. So in the short term, they do see some risk of a correction due to overheating in AI-related stocks and quarter and rebalancing as well. But many investors believe that growth in computing power to support data processing and growth in memory demand will likely continue for the next several years. They also believe that stronger demand will benefit the whole AI supply chain across Japan, Korea, and Taiwan as well. And one topic that came up as a next bottleneck for AI investment was X-ray inspection technology, because HBM requires multiple memory chips to be stacked with very high precision. And as this structure becomes more advanced, it becomes more important to detect internal misalignment, bonding defects, and voids and cracks and other issues as well. And if we look at this, my screen in this chart, so we use Japanese AI-related stocks as our universe. We created baskets based on each core theme, and we look at the exposure returns versus the overall AI stock universe. And in the early stage of the AI rally, the blue line, which represents optical-related names, outperformed very much. And after that, the yellow line, which represents memory and testing names, caught up. And more recently, the purple line, which includes power semiconductor and thermal-related names, as well as MLCC-related names, has started to outperform very quickly. And within the broader testing and inspection area, the stocks that have led the market so far were in the green line, test and assembly equipment. And this includes probe cards such as Micronics Japan, or test sockets such as Yoko or Yamaichi Electronics, and hybrid bonding such as Shibata Mechatronics. The light blue line, inspection and methodology, is related to identifying the cause of internal defects and bonding failures. And in stock price terms, this area has lagged test and assembly equipment. But several investors pointed out that as advanced packaging moves into larger scale production and yield improvement becomes more important, X-ray inspection equipment and related technologies may have room to catch up within the AI value chain. And these are classified under inspection and methodology in this light blue line, and include names such as Omron, Hamamatsu Photonics, and Rigak as well. There was also strong interest in how to hedge a reversal in AI rally. Investors continue to appreciate the medium-term growth potential of AI-related stocks, but they also seem to be preparing more carefully for short-term credit positioning and higher valuations. And in this context, our recent change to our forecast list, especially the addition of Morinaga Milk, were received very positively. Investors saw it as a stock with a growth story that is different from AI. The story is driven by global demand growth related to GLP-1 and whey protein as well. So on sector preference perspective, we basically overweight B2B supply chain upstream sectors rather than B2C more consumer-oriented sectors because still my understanding that we're standing at a very early stage to expect Tagaichi's policy premium on those supply chain upstream sector. And we can expect a really strong global and local demand in those sectors as well. And regarding FX intervention, as dollar yen has moved above 161, which was high reached in 2024, investors are starting to ask more often about whether FX intervention could happen again. So in this perspective, looking only at the level, it is true that actual intervention would not be surprising at any time. That said, our macro strategist Sugisaki-san points out that based on recent comments from the Ministry of Finance, there still seems to be some distance before actual intervention. And the Finance Minister Katayama-san has said that the authorities are ready to take decisive action at any time if necessary, but she has not yet clearly described the recent FX move as speculative. To be sure, since the FX intervention at the end of this April, the rise in dollar yen has been driven more by broad US dollar strength rather than by yen weakness alone. And in fact, the yen has actually outperformed other G10 currencies, excluding the US dollar. So given this price action, the authority may still not be fully convinced that speculative yen selling has once again reached an extreme level. So if dollar yen rises further from here, and if that move is clearly led by yen weakness, the Ministry of Finance may become more likely to describe that move as speculative and carry out actual intervention. And if FX intervention does happen and speculative yen short positions are quickly unwound, we could see similar pattern to the summer of 2024. In the short term, this could lead a reversal in cyclical high momentum stocks in Japan and a decline in bank stocks as expectations for BOJ rate hikes fall, and relative performance by low volatility domestic demand stocks as well. But the current situation is very different from the summer of 2024. This time, if we look at this L1 infra policy rate differential, the Japan-US interest rate gap is widening recently. Also, the fact that dollar yen is trading above the level suggested by the Japan-US policy rate differential may reflect weaker confidence in Japan's fiscal credibility. So even if FX intervention is carried out and Japan equities in a reversal, I believe the shelf life of this bear trade is likely to be shorter than in the summer of 2024. I hope that makes sense. And back to you, Crystal.
Thank you so much, Sho. And then before you log off, just want to several quick questions here. I think the first question is that just now you briefly touch on the JPY carry trade, and it seems to be like relatively higher than earlier part of this year. And then I know that you mentioned that maybe August 2024 may not repeat, but then if there is a drawdown risk, how should people position for that?
So if we look at this leverage funds yen positioning, the yen short positioning level is already equivalent to the last significant FX intervention period on the summer 2024. So both the dollar yen level and the leverage fund positioning perspective, as we've mentioned, I think the risk of FX intervention looks like really high. And if we assume the investors constructing yen short positioning and long on Japan equities unwound very sharply, we have to be careful about the sudden, reversal, especially high momentum and high volatility stocks on Japan equities. But as I pointed out, the current dollar yen move is fairly in line with the fundamentals, especially dollar yen rate differential, US and Japan rate differential, and investors are pricing a negative risk premium on the yen because investors have a typically expansionary fiscal policy bias on the Takaichi administrations. So in that sense, if we couldn't find any significant fiscal policy improvement management from Takaichi administration, I think fundamentally it's really tough for us to expect a sharp dollar yen correction in a kind of medium to long term perspective.
Thank you, Shou. And then another question here is your sector views within the space, especially on financials. And then do you also recommend a barbell strategy also in Japan?
Right. So Ibala is my really favorite name, but you mean space is aerospace?
The whole of Japan, like your sector allocation.
Sector allocation perspective, I mean, so basically, so for banks, I'm equal weight on banks right now because if you look at the terminal rate pricing in Japan, which is already reaching to 2%, which is meaning that markets are pricing formal rate hikes from BOJ over the next 2 to 3 years, and I'd say it's too much. And I'm expecting a kind of downward pressure on the JGB yield personally because of the Japan version of Doge initiative and the potential risk of FX intervention might negatively affect the market expectation for the BOJ rate hike probability going ahead as well. So all in all, bank sector is attractive in terms of the earning, momentum and the shareholders' return perspective. But at the same time, it's really tough for me to justify the overweight on banks because it's really difficult for me to assume the late BOJ's rate hike, acceleration scenario going ahead. This is the one thing. But again, I basically overweight on B2B supply chain upstream sector. And this is our sector preference table. But as I pointed out, I basically overweight on the supply chain upstream sector, like including construction and the chemicals and non-metals machineries and high-tech names and trading corporates as well. By contrast, I underweight on consumer-related sectors, including foods, pharmaceutical, auto, and transportation, logistics, and retail as well, because those B2C sectors are relatively difficult to pass through their input cost increase in Japan.
Got it. That's very clear. Thanks so much, Shou, for dialing today. And then next we have Rajit today with us on the line. And then the Fed seems to be less hawkish than the consensus. And then seems like we're still maintaining the view of a Fed on hold this year. And then how has the reaction function changed and also the guidance kind of like function shifted with the new chair? Over to you, Rajiv.
Hey, Crystal. Thanks for having me. I think it's been a difficult couple weeks if you're a fixed income investor, and our general view has remained constant throughout. We expected a change in communication from the Fed chair. We perhaps did not expect it so fast, and I think the market is in the same position where they were expecting change, but perhaps not pivoting so fast, so quickly. And effectively what we got was the Fed chair ceasing to give forward guidance in his first meeting. And in our view, the markets ended up going to price the dots in the dot plot. And we didn't think that that made a lot of sense. We've written about it extensively, but effectively, first of all, the dots, it is unclear how much oil expectations were in the dots because the deal on the Strait of Hormuz was announced 2 days prior or a few days prior to the meeting of the last FOMC and signed during the meeting. And until that deal was signed, the Fed members were not really going to be able to take it into consideration given how much volatility there has been in the Strait of Hormuz negotiations. As a result, the dots in the dot plot, many of them likely included an elevated oil price that we think is the reason why the dots moved from 2.7% core inflation in fourth quarter, which is where we were before the oil conflict, to 3.3. And on our math, that should have only gone to 3.0 if there was a deal scenario. And so we think that going to price the dots, which is what the market did initially, risked having downside surprise if the deal stuck. And so far, oil prices, and I have no view on the deal sticking, but oil prices are behaving as if the deal is going to stay around. As a result of that, the temporal implication of elevated oil prices is actually limited to 1 quarter, even though it may have felt like much longer. And in macro terms, particularly macroeconomic terms, 1 quarter of disruption is going to likely be transitory. We've started to see this already. Euro area HICP yesterday surprised to the downside. And in the US, we think that similar dynamic is going to play out in headline inflation, if not in the June print that we get in July, but for sure the July print that we get in August. And as a result of that, we've been very focused on the data and our data forecasts rather than the dot plot itself, which is why we have long held the view that the Fed should remain on hold. Yesterday at Sintra, where actually some Morgan Stanley economists are at as well, our chief global economist specifically, Kevin Warsh in his speech mentioned, or his panel with, I think it was with Christine Lagarde, mentioned that he saw inflation expectations had moved lower. And this is the other point actually I had sent to clients, that while the 2-year yield in the US went to go price rate hikes, 2-year break evens in the US collapsed completely after the deal was struck, implying that the break even market viewed oil lasting less than a quarter as transitory inflation. This is, I think, what Chair Warsh was alluding to in his speech yesterday. It dovetails very nicely with our call, which is that let's focus on the data. The data implies that inflation is likely to be lower at the end of the year rather than higher. It will be a struggle to move lower, but it's hard for it to move higher in our view. And the main reason is that tariffs are now moving past 1 year. And so the 65 basis points of inflation that tariffs were contributing to core PCE will start coming out of the inflation prints over the next 6 to 9 months. And those 60 basis points that will be kind of a down or, a tailwind to lower inflation or downward pressure on inflation are far greater than anything that we've been able to estimate from oil, from AI, or from labor market. And basically you can add up the labor market pressures, the AI pressures, and the oil pressures, and it's still in aggregate, still less than the tariff disinflation in our view, which is why we've been focused on a Fed on hold rather than a Fed hiking. Obviously, we have to see the data play out, and these are all kind of new territory, uncharted territory in terms of inflation modeling, tariffs, AI, and oil shock, as significant as we saw in the Strait of Hormuz. So clearly we need to wait for the data, but based on kind of our modeling and historical statistical relationships, our baseline expectation is that inflation is sideways to down. And in that scenario, we have the Fed on pause. And I think, though, that even if you follow the data, it's going to be a choppy few FOMC meetings, first in July, then in September. It's a new convention of communication. Every time we get a new Fed chair, we have volatility in the front end. Our rate strategist, Matt Hornback and team, published some statistical analysis historically that looked at price action in response to NFP and CPI and new new Fed chairs, and you can see that we're moving back to a kind of Alan Greenspan style regime. And you can see in that statistical analysis that there is greater volatility when you have that style of communication, and that's just the way it's going to be going forward, it seems. I'm focused on, where these tasks, those of you that follow closely, Chair Warsh announced a few committees to do investigations, these task committees. I'd be looking forward to see who's appointed. We're seeing some names floated in the press already for communication and for balance sheet and so forth. So let's see where we end up with those task committees. But overall, I do think this is a new era in terms of Fed communication, but we do not think it's a new era in terms of the Fed being focused on 2% inflation and basically the statistical relationship between the long history of inflation data that we have and going forward. And that's why we lean into kind of our data-driven approach in inflation and what we expect from the Fed. Maybe I'll stop there. I don't know if there's any questions. I know we've got a lot of speakers still. So Crystal, over to you.
Thanks, Rajiv. I think we'll leave all the questions towards the end of after everyone has commented. So now we are moving on to Jenny, and then Jenny will talk about the China and EU trade tensions, and then also your case study on Hefei as well. Over to you, Jenny. And then afterwards, we have Laura to talk about China's strategy. So over to you, Jenny, first.
Hi, morning, everyone. So China's K-shaped economy has deepened in the second quarter. And as we can see, export growth is running at 15 to 20% year-on-year on the global capex super cycle led by AI and energy transition. But on the other hand, the domestic consumption and investment has slowed down. Now the second quarter GDP growth is tracking at 4.4%, below the government's target range of 4.5 to 5%. So that has led to increase the hope for additional stimulus in the July Politburo meeting. But given that there remain close to around 2 trillion RMB on budget fiscal impulse for the second half of this year, we don't expect further budget expansion. But policymakers will likely focus more on the faster rollout of the infrastructure push with focus on AI computing, data center, and smart grids, and possibly will not introduce new consumption stimulus. So in this context, we think the K-shaped economy is here to stay. The key debate is whether export strength can be maintained and if China can count on exports and better industrial policy to sustain growth without deflation. On the first debate, we have argued that the export strength is not a cynical story, but it would be a multi-year structural boost from global industrial capex upcycle driven by AI, energy transition, and national defense. And it could further accelerate in the near term if oil price normalization can be sustained. But recently, we see the market has started to focus on increasing China-EU trade tensions, and they question whether a sub-escalation could put a stop to China's export momentum. After all, we see EU is now China's second largest export destination. It accounts for around 15% of China's total exports. And based on our analysis, around 2/3 of China's exports could be exposed to higher trade barriers. Besides the plug-in hybrids that are already under the spotlight, we see machineries, chemicals, and base materials are also exposed to the risk because these are the sectors where the EU runs widening bilateral deficits, and also the EU also retain the global competitiveness in these industries. So basically, they are competitors with China. And in other words, we think now 10% of China's exports are exposed to the trade barrier risk from EU. But we think the imminent risk of escalation is manageable. First is that the EU has made it clear that it tried to do the de-risking rather than decoupling from China. And particularly, we see EU remain highly reliant on China for rare earths and green tech supply chain. And also China has various retaliation levers like the rare earth control, like the EU's market access to China in aviation, autos, and luxury goods. So this will reduce the possibility of imminent aggressive trade tensions. And earlier this week, we also see the China-EU just had the establishment of the trade and investment consultation mechanism. So this actually is a positive move on that front. And second is that the U.S.-China tariff exposed episode also so that the tariff pressures can actually be partly mitigated through the trade rerouting and the supply chain configuration. And the first can just shift the sourcing, assembling, or like export channels toward third market like ASEAN's. And also for Chinese firms these years, they have been seeking for like a go-out strategy to expand the overseas manufacturing capacity. So this will provide an additional buffer. Even if the direct exports to the EU face higher barriers, China can continue to supply intermediate inputs to the offshore production hubs. So we think that even if the tariff escalation increase, the impact on China should be relatively manageable. But on the second debate, whether China can reduce the excess capacity problem with the export strength and better industrial policy, here we just do a case study on Hebei province, because this province has been cited as the most successful growth model in China, where the local government do not just give like land and subsidies to the corporates. Instead, actually, they just add like a VC investor and eco planners to anchor the lead firms to resolve the supply chain bottlenecks, and later on when the firms grow and become like a national or global champions and go for like public listing, they just conduct the market-based asset and get a profit from there. Then they recycle the gains into the next strategy sector. And over the past decade, you can see the city that actually has rescued NIO back the CXMT, and they have already cultivated China's race in advanced display manufacturing. But eventually, this city also have the excess capacity problem. As you can see from the right-hand side chart here, its deflation actually was more severe than the national average over the past few years. And also, we argue that the replicating Hebei's strategy is not really easy in other cities or provinces, because Hebei's success actually also count on timing and very broad bets. And if you just apply the same playbook nationwide, it could risk compounding the overcapacity problem. And we think Hebei's case just tells us that the better industrial policy will only improve the investment allocation toward the more productive sectors, but it cannot by itself to change the supply-heavy incentives that cause China to invest too much and consume too little. And as we just discussed, when Hebei's government just made the market assets, they will focus on putting money toward the next strategy sectors for the investment rather than just supporting consumption. So that means supply will continue to be larger than demand. And whether the better exports to help to just like absorb the excess capacity and create a more like a domestic demand, for example, they just create more jobs, we would not completely deny that, but we just see that the exports now has its own limit. First thing is that today's export drivers are more capital intensive, so the effectiveness on like job creation will be weaker than we saw the decades ago. And also we argue that the over-reliance on exports could also expose China to the global cycle and also invite the protectionism from other countries. That's like what we see in EU today. And therefore, we just argue that if we really want China to get out of the deflation completely, we still need the economic rebalancing efforts, like the structural reforms to change local government's KPI from output volume toward household income and consumption. We also need to reduce the fiscal revenue reliance on VAT toward the direct tax, which reward efficiency rather than scale. And also we should strengthen the social safety net to unwind the elevated precautionary savings for consumption. To be honest, none of these reforms are easy, and also we can see progress to date has been incremental. That is why we argue that the K-shaped economy will be with us for some time, and we are not really out of the wood of the deflationary pressures. Yeah, let me stop here and then hand over to Christine. Thank you.
Thank you so much, Jenny. And then last but not least, we have Laura online today. And then can you share your views on China? Because there has been an underperformance here today of China indices. And then can you share the second half outlook as well, together with the A versus H share preferences? And then apart from the sluggish index performance, your focus seems to have done really, really well. And then can you also share your sector allocation views too?
Thank you so much, Crystal. So glad to be on this webcast. We just finished a multi-week global marketing trip together with our econ team. I myself teamed up with Jenny, as she had mentioned earlier, about the feedback we've collected on the macro side. So I will share, using today's platform, a lot of feedback we've collected on Chinese equities. I think first and foremost, the biggest takeaway is that the level of interest in Chinese equities has been rising. This actually came out as a quite nice surprise to us, because to Crystal's point, year to date, Chinese equities performance had been lackluster at best, compared to particularly some of our neighboring markets such as Taiwan, Korea, and Japan. But investors told us basically three reasons are driving their increasing level of interest in Chinese equities. Number one, basically, is the diversification need. I understand the last couple of days, some of the Asian markets, including the global AI-related stocks, have been correcting in a big way. But up until this point, a lot of investors have been holding very concentrated positions in some of these names, and to the extent that some of these positions have started to hit the single stock positions threshold within the portfolio, within the mandates. So China, as one market that's usually least correlated with the global market, does serve very nicely as a diversification destination. And number two, to my earlier point about China underperforming year to date, the valuation has also corrected to a certain degree. So investors feel that from a mean reversion perspective, whether China as a laggard is going to inflect at some point and start to catch up. And number three, basically, given that the macro backdrop continues to weaken, investors are building up hope towards potential pickup of fiscal stimulus, and that could offer some good opportunities for cyclical stocks from a rotation perspective. That being said, I mean, we have been recommending investors to put more money in the A-share market versus the Hong Kong market since pretty much this time last year, and that had actually really worked out very nicely. To the question about buying the dip because of the fact that China has been laggard, we think you need to be careful about that. Valuation has, I think, normalized or rationalized quite a bit. MSCI China now trades at around 10 times forward PE. But this is not one of those sort of historical trough levels we would see and then pound the table and say, at this level, you could just buy without asking too many questions. What would that level be? I would say MSCI China will have to trade below 9 times for us to be more confident to call that a sort of historical trough. We've seen that a few times in the past, for example, back in mid-2024 and back in October 22. And then, of course, pre-COVID, we've seen that around 2016, etc. And more earlier, I would say post-GFC. It hasn't happened that often, but every time, regardless of the composition of MSCI China as an index, If actually the index started to trade towards like below 9 times or even towards 8 times, then usually the chance of a very imminent rebound would be very high. The current 10 times forward PE, I think it's not there yet. And then on the relative basis, MSCI China now trades at about a 15% discount versus the broad emerging market. Again, the historical trough of that valuation discount would be around 30%. So what I'm trying to say is that it makes sense to look at China for all different reasons, but valuation cheapness, absolute cheapness, should not be one of those reasons. And the outperformance of A-shares versus Hong Kong has been largely driven by, number one, a much bigger representation of a lot of exciting tech and innovation related stocks being traded and listed in the A-share market. And then the other reason for that outperformance of A versus H is because Hong Kong is overly skilled towards the internet sector, which has been, I would say, has been suffering from, number one, the weakening macro backdrop, particularly on the consumption side, and number two, the severe price competition these e-commerce players had engaged since summer last year. And number three, the CapEx investment some of these internet companies has committed for this year on the AI investment front. So what we are monitoring very, very closely for a potential inflection point for the Hong Kong market would be along the following fronts. Number one, the second quarter results season. We want to focus on this because there is a fair chance for the second quarter results to be less bad, to show some early signs of improvement compared to the previous few quarters. This is because starting from April, a lot of the e-commerce players had been advised, or rather commanded, by the onshore regulators to rein in on their severe price competition against each other. So the earnings damage from these price competition could start to become much, much less for the second quarter results. And then the second reason for us to focus, for the second development for us to focus in the next couple of months is that third quarter will be a very busy quarter for a lot of companies to either introduce AI functions into their ecosystem or to launch their new versions of large language models. We will see whether these launches will, number one, successfully get executed, and number two, if they will show significant improvement of performance or commerciality outlook to convince the capital market that the CapEx investment is money well spent. And the third development would be the share unlocking, the upcoming share unlocking in the Hong Kong market. We actually have a large number of companies with IPO share unlocking coming up in the next couple of months, with very heavy concentration in months of July and then in months of September. So we feel that the market will need to digest those selling pressure at individual stock level, but collectively at the overall market level to have a better, more stabilized liquidity situation. So the next couple of months would be extremely important to monitor. If they get executed in a timely fashion and with actually quite good data support, then we feel that, towards the end of July and August, things could start to lighten up quite significantly for Hong Kong. But we need to make sure these things really happen before we get too excited and start to put more allocation back into Hong Kong. And Crystal talked about the quite sort of superior performance of our focus list and our sector preference. We have been quite persistent with a strong preference for tech and innovation, particularly the champions on the global basis. We don't want to focus too much on domestic demand because the spending either on the public side or by the private sectors would still be somewhat questionable given the macro backdrop. So those actually had worked out pretty well. But at the same time, we also want to keep a decent exposure to companies with quite a stable dividend yield for us to gain that stable cash returns when things can be volatile. So, for example, we still keep certain exposure to the material sector and to the more traditional kind of energy coal sector, and also to insurance sector for those kind of a stable cash return. And we do have a very heavy proportion of our focus list dedicated to the Asia market stocks versus the Hong Kong stocks. So I think collectively those had been the big drivers of our focus list performance. I think the next step would be, when the Hong Kong sort of inflection point could take place, and whether that would be either enhanced or disrupted by this ongoing global market volatility. China tends to outperform when globally things look really, really bad. But it would be unusual for China to deliver very significant absolute positive return when globally risk sentiment is actually receding in a very significant way. So we need to be very, very careful about that. I think the Asia market would also enjoy the national team's liquidity support. So in a severe scenario of global risk of sentiment event, then Asia market will still tend to outperform with that strong domestic investor base and with the potential large amount of dry powder that could be provided by the national team to stabilize the market. That's it from my side, and back to you, Crystal. Thank you.
Thank you, Laura, for the very comprehensive views. And unfortunately, today we won't have time for the Q&A, and we will answer remaining questions offline. Thanks so much for joining us today, and then do reach out to me and the team if you have any other questions. Have a nice day and see you next week.